I just had a general question. So, given the volatility of the market in the last 3 years due to COVID, do you find it useful to view ratios like the PE ratio and the PS ratio over multi-year averages, or do you typically just stick with that typical 1 year rolling?
Yeah, I don't use ratios. I think they're kind of like more or less like a poor person's or an uneducated person's guide to the market. It's kind of like, I don't know, like there's so much more to a company that can't be embodied in a ratio. For example, the primary thing is risk, right? Because you could have a company that's growing at 10% that is trading for 20 times earnings, and then you have another company growing at 10% that's trading at 20 times earnings. But company one is far riskier than company two, and company two perhaps has a lot of one-time costs that are depressing its earnings. So you have to, if you're going to use multiples, the very least you have to use adjusted earnings, which is already kind of like starting to screw things up. So to me, I think the number one thing you got to do is just value the company, like you work at KKR or Carlyle or Blackstone or some other private equity house, maybe like Berkshire Hathaway, and you say to yourself, would I buy this company and take it private? And if the stock's at 50 and you would pay 100 to take it private, then it's a good long. But if it's at 50 and you would pay 50 to take it private, it's not a good long. And if you use that framework, generally, I think you can make money in the markets, at least as an investor in the long run. Now, PE ratios aren't useless, but I think there's so many issues. Like, for example, if I remember when Pfizer was trading at 10 times earnings, of R&D was trading for like 6 times earnings. And this is a portfolio that was going to last for a long time. It wasn't just earnings disappearing. So price to earnings ratios aren't terrible. I think price to sales ratios aren't very useful because you don't know what the margins are, right? You can have companies that trade less than 1 times price to sales, but they have 5% margins, right? So the math is kind of tough to use there. For software, it's sometimes useful because you generally assume there's a lot of margin. But even then, that can be dangerous. So I think multiples aren't, like I said, the worst thing in the world. A lot of people use them as a lazy method to value companies. If you're valuing companies, you shouldn't be lazy. You should be really, really careful and really kind of thorough. And I think that, again, try to take the perspective of somebody who's taking over the whole company instead of somebody who's just sort of like wants a quick and dirty trade or something like that. So I just try to be very thorough. And a lot of the companies I deal with don't have earnings, right? And that doesn't mean that they're bad companies. For example, for many years, Tesla had no E for PE, right? But it's still one of the best performing stocks ever. So how do you use the E if there's no P? How do you use PE if there's no E? You have to make adjustments and you have to use future out years and so forth and so forth. And all of that, there's an app for that. It's called the DCF, right? So you do a DCF or a DDM and you can get a fair value for a company based on its future cash flows, which is, kind of what private equity firm does. So private equity firms don't buy growthy companies usually, but we can, and we don't have to buy entire companies. We can buy shares and take advantage of so-called Mr. Market. So that's my sort of 2 cents. It's a very Graham and Dodd approach, but it does work and keep you out of trouble. It may not double your money every year, but it will give you decent returns if you follow that like Warren Buffett kind of, Graham and Dodd approach.
Good to know. Thanks.
Yeah, I know other people here are traders, and I really respect traders because what they do is very, very hard.
I know Jeremy's got a lot of fundamental knowledge in the market.
Yeah, Jeremy's really good.
He's like my little fundamental quant if you wanted to hop in anytime. And
I mean, hey, Martin, it's nice to talk to you. I don't think we've had a chance, really collab on Spaces before, but I think you bring up a good point. And to the question that was asked earlier, when you're looking at valuation on a historical basis, you have to take into effect what the macroeconomic backdrop is during that time period. And if you're just going to use like this kind of cut in stone, PE proxy, it's important to note that earnings revisions have fallen back to, the levels they haven't seen for 5 years now. So if you have compressed earnings, at least for the, midterm horizon here, just because something looks cheap on a historical basis, optically cheap on a historical basis doesn't necessarily mean it can't get cheaper. So I definitely agree with, Martin. with the fact that you can use some tools like a DCF to build your own sort of outlook on how you might value the company. And obviously there's a lot of internal factors there, right? Like, do they have a moat? You know, do you like the management team? Is there something that, you know, they really deliver that offers some differentiation throughout their comps? So there's a lot of factors that come in. And as you mentioned, like the volatility that we're seeing right now is pretty incredible. You know, me personally today, I thought today was interesting because we kind of saw this inflationary trade resurface, right? You had the 10-year, I think, break over. It was like 3.02%. So, you know, levels that I didn't see from early May. And I'm sitting here thinking to myself, right, we have a Federal Reserve that's going to start, you know, tapering asset purchases in June by, I think, 47 million. You know, the first taper starts June 17th. And then come September, they're going to ramp it up to 90 million. I'm sitting here thinking to myself that we have a, you know, 10-year bond auction on Wednesday. Are there necessarily going to be, you know, foreign participants to step in when, you know, the dollar is also rising at a pace we haven't seen since 2014? The cost of capital is increasing substantially, and the largest, you know, international buyers, Japan and China, are seeing sharp depreciation of their currencies against the dollar. So I do think we saw a little bit of front running there. It'll be interesting to see what happens on Wednesday, especially, you know, with the CPI print on Friday too. I think that's going to be a key metric for, you know, governmental treasury stability. If there is a surprise to the upside, we definitely could be due for some volatility heading into the quarterly OPEX. So just, you know, pretty crazy times these, you know, this week and next. I think we should get a little more clarity in the back end of June and like heading into the summer. And then obviously come September, you know, the Fed has hinted at a potential policy pivot. So, you know, the markets might try to front run that throughout the second half of the summer if all these, you know, leading economic indicators cooperate. So those are just some stuff I'm trying to look at here. You know, Martin, I'd love to get your, you know, viewpoints on what you're seeing kind of on a day-to-day basis, especially with like the stagflationary trade like resurfacing today.
Yeah, I was just going to say, I don't really pay attention to the macro too much because I found it very hard to handicap over the years. You know, if you try to tease out alpha, like for me, like, you know, managing a biotech portfolio where you have market neutral exposure. And then if you know, want to do tech, you know, let's say you have 4 really solid long software ideas. I think your best bet there is to find 4 stocks that, you know, you're convinced are going to be relative underperformers to your 4 longs and just try to stick to that. Now, if your life is going to depend on trading macro, you got to look at all the things that you're talking about and then some, right? You have to look at spreads. You have to look at all types of crazy things, right? There's people that trade rates, right? Steepeners and flatteners, you know, using swaps that trade rates for a living. And you can make a lot of money trading rates. You could lose a lot of money trading rates. Same thing with equities, right? So for me, I'm an equity guy. I'm good at, like you said, sort of figuring out whether a company's got the right kind of moat, whether or not you like management, whether or not you want to buy 5% of the company or all of the company sometimes, which I've done a few times, or just be a small passive shareholder. You know, the volatility is your friend when you're an equities guy or gal. When there's when you have other people's money, it's a very tricky game to play. Like some of the multi-strat hedge funds are doing pretty well this year because they're more market neutral. And then you have the guys like Tiger and others that are suffering. They're down anywhere from 10 to 50% because they're basically long biased, right? And they're in privates, and you can't short privates, right? So they're ultimately in a whole lot of alpha. I'm sorry, a whole lot of beta, and it's very high beta stuff. So, you know, to me, I like to sort of, you know, if I'm long Pfizer, I got to be short Merck. If I'm long GSK, I got to be short Sanofi. If I'm long Amgen, I got to be short Gilead. You know, that's the kind of portfolio I like to build. And if I can't make money doing that, I think Julian Robertson, the Tiger founder, I've worked at a Tiger Cub, but the big Tiger boss, who's like 90 years old now, he said that if you buy 100 of your favorite stocks and you short 100 of your least favorite stocks and you don't make money at the end of the year, you're in the wrong business. I think that sort of, it applies to crypto, that applies to macro too. Like I used to talk to a lot of Soros guys. The Tiger Cub I worked at was initially funded by Soros, and I became friendly with a couple of Soros portfolio managers. And even then, right, like they have portfolios where they're long Thai baht and they're short Swedish krona. They're long, euro, and they're short dollar. They're long bonds and short stocks. And Ray Dalio does that stuff, obviously, at Bridgewater. So if you're a good trader in macro or stocks or whatever, great. If you're a good quant investor and you program really great algorithms, great. If you're a fundamental bottoms up kind of private equity focused person like me, you can make money. There's an infinite number of ways to make money. I think the only things that really, as as a trader, that really matter in the long run are your own psychology, risk management, things like that. And, again, I'm not a macro guy, but, I for like 6 or 12 months, I moonlighted following macro, and it's a hard space. It sounds like you keep on top of it pretty well. I disagree with some of what you said about bond auctions. I think China's got plenty of reserves, and I think that with the interest rate hikes that we're seeing in our country, this currency is the currency you want to own, and we've seen that, right, with the dollar index. But again, I'm not a monetary economics expert or anything, so I'll leave that alone. But it's a totally different dynamic trying to understand the economic trends and those complexities versus the micro kind of like little trends, like does this cancer drug work, or does this arthritis drug work, or is this drug not going to be safe, or does this blockchain really provide a solution, or does this NFT class of goblins, is this better than, I'm long goblins and I'm short apes? That's a good pair trade. So I don't know what you think.
Is that a thing yet? Can we short NFTs?
We were talking about that the other day, honestly, and
yeah, we're working on it. Yeah, goblins.
The issue about Bored Apes, though, it's like there's so much like celebrity and like influencer money like pumped into it that's
a good thing.
That is true,
that
but
means
like
nothing.
If you asked me if I could trade against Eminem, listen, I don't want to be in a rap battle against him. But if you told me, Eminem wants to put $10 million on a trade, I'm taking the other side of that.
That's a fair point. I guess I was more so like, getting at that like money potentially is like a little bit more expendable for them. So, they might not be forced sellers. And
you just have to wait, right? Like you just have to find the right entry point and wait. It applies the same thing as I mean, you sound like a very experienced market participant. I mean, it kind of applies to anything that's kind of going parabolic. You have to ask yourself, do you want to short the first half of the parabola, or do you want to short it like when it's clearly put in its peak and it's starting to come down? I think Bored Apes have clearly put in a peak, right? I mean, there's nothing new. I mean, other than the other side metaverse thing, which is kind of like the only way to keep this thing breathe new life into it, which is very smart on the Bored Apes people part. They kind of have, created a new product, so maybe it'll work out, but I don't know, man.
Yeah, I don't think they're going to
JPEGs.
zero by any means, but like over evaluations for sure across the board.
Yeah,
it's like 400K. What's it? I don't. I'm not a big crypto guy whatsoever. I don't really follow it. But it's like what, like 400K for a JPEG at this point?
More than that. And the average one, yes, is a little lower than that. But there are plenty that are close to 1 million or more. And so, like, to me, if 5 years from now, that's the old Warren Buffett question. And you're gonna have to excuse me for this whole stream because, like, I'm a Buffettaholic or a Buffettologist. I do believe he's the GOAT by far. And basically, ultimately, he wouldn't buy, 10,000 JPEGs for $2 billion. I think 10 years, so he's always said, pretend the market's going to close for 5 years. I think 5 years from now, like, I really don't think that they'll be worth that. And again, maybe 10 years is the better number. But, you have to ask yourself, what's the final price of this thing? And ergodicity, that sort of concept of we're seeing stochasticity right now. It's a very stochastic market, but I really don't think the JPEGs last in the long run. But I could be wrong, and I'm willing to be wrong. It's not like the super high conviction idea I have. I would like you're to the guy earlier's point who bet 1% on a lunar reflation over the fork. Like that's a 1% position, right? That's not a 50% position. 50% position is when you have it dead to rights and for a fact it's going to fall apart. That's not the case with Bored Apes. So they could go up. I'm not saying I'm putting my foot down and I'm 100% right. But I think a 1% short position in Bored Ape Yacht Club would be fun. and profitable.
This is sort of related to blockchain, right? In blockchain, if we think about like decentralization, this is sort of a prerequisite that I see is like important, and I think a lot of people hold as important. Without decentralization, we might as well just go back to traditional relational database management systems, right? So maintaining decentralization feels like an important sort of area of innovation that like Bitcoin and Ethereum did differently over the last several years. Enrique, earlier you brought up the blockchain scalability trilemma, which I think is a pretty big topic of conversation. And the thesis here is that enabling anyone to be a validator or block producer using consumer hardware enables a lower barrier to entry, which has the downstream impact of making sure it's a larger, more decentralized network, right? So I guess my real question is, how do you balance the need for scalability while also maintaining that decentralization at the base layer? How important is it to ensure extremely decentralized blockchain network? And do you look at things like layer twos, such as Optimism, ZK Sync? What specifically attracts you to Algorand and some other networks? Thanks again.
Yeah, without getting into too many weeds, and I gave Raul another paper to throw up. I mean, people have been talking about concurrency and async and programming for 40 years, right? It's not been like a new thing. And I think that, certainly the new thing is that there are all these nodes willing to participate now. And I think that sort of is what solves the trilemma. And so you're right. I mean, I think the fact that anybody can be a Bitcoin node and, is a great thing. But if you also look at the node number, it wasn't that high when I last checked it. I was in prison. I still think, you guys know, is it 10,000, 15,000? Let me put up the paper. I keep DMing it to you by accident. Sorry, I forget what you just told me 2 minutes ago. So yeah, there's a bunch of papers from the 80s that I'm just going to throw one out there that, talk about concurrency and again, like if you look at threaded programming languages, right? You have issues with things like C versus say JavaScript because you have a lot of problems with having more than one thread and race conditions and the execution loop and all that stuff. Programmers have to deal with on a daily basis. So without getting into technical, matters, which, I'm not sure I can even do necessarily, I do think that you have, a solution in the form of, the massive number of nodes. And clearly these networks need more nodes, right? Solana, Algorand, all these things. And that's where the Gini coefficient comes to play to some extent, right? But we spend time looking at the wrong part of the Gini because I think the most important part is the number of nodes that are really stable and supporting the network. And I think that, it's hard to sort of get nodes unless you have, you have some incentive for them, right? I mean, the first time I downloaded the whole Bitcoin blockchain, I very shortly thereafter deleted it. And I said, why did I do that? This is useless. I just took a whole bunch of gigabytes off my hard drive and, I didn't get anything for it. So I think there's sort of, all the nodenomics that sort of have to take place to really ensure that you can sort of have your own trilemma solution. And again, I don't know which one's going to sort of solve it. I think right now that question is an open question. Certainly layer 2 is an obvious sort of turbocharger, because ultimately, like if you think about eventual or verifiable, eventual sort of concurrency, I think for a lot of use cases, eventual concurrency is what matters. So, whether it's a verifiable delayed function or, whatever mechanisms that you can use to sort of eventually get concurrence or consistency, I should say. Every node has the same data. It's okay if you don't get complete consistency immediately in some cases. So again, depends on the use case, right? For money, that doesn't work. But for certain other things, there is sort of some wiggle room. So, eventually the network has capacity, right? So you might have little capacity in really tough times, but, if there's eventual sort of capacity available for compute or for resharding or replication or whatever, I think you have a benefit from that. So, again, I don't know. If I had the answer, I would implement it. We're going to have to sort of wait and see. And I think that you have, part of it is experimental and theoretical and experimental are very different things, right? You have a lot of great theoretical solutions, and then you have to actually sort of make it happen. And I think, whether it's going to be, something we have now, and it's just going to need a little more scale and more nodes joining a network, or if it's something that hasn't been invented yet. I do think I feel fairly good that we're going to get a solution. And in fact, I don't think we're too far away from one, based on some of the performance in some of these networks. Like Algorand's never had downtime. It certainly seems safe to me. Scale is the bigger question for a lot of these things, right? Again, I was joking that Bitcoin's TPS wouldn't support the block I live on, let alone the entire globe. So I think a lot of people who have sort of who feel like we're changing the world and that everything's changing because of the Bitcoin and blockchain, we have a ways to go. We actually don't have that much throughput in a realistic basis, and that's neither on Bitcoin nor on Ethereum. I mean, the number of actual transactions per day, does anybody know off the top of their head? I think it's several 100,000 on Bitcoin. That's not very many. That wouldn't be a lot even for, like I said, one borough of New York City, let alone, the whole planet. Default.
What's your opinion on Lightning for Bitcoin and the plausibility of its use case?
I don't know for sure. I don't know, so let somebody more advanced answer that question, but I'm not sure.
A question I have maybe is you see any cryptocurrency becoming a medium of exchange instead of the US dollar, I guess.
Yeah, I don't see any reason why it's not why it's impossible. I think that there's all the reasons that we can all agree on why it may be difficult or frustrations may abound, but I do think we're ready for a new technology in money, and money is a technology like any other technology. So I don't see why we can't move off fiat, and I think in fact we inevitably will, for a number of reasons. Freedom is probably one good one. People want to be free, and fiat's sort of a constraining paradigm. Anonymity is something that's probably what people want, whether they know it or not. I think that's a great use case and reason. And then finally, you have kind of global utility, right? I come from a country called Albania, which is a pretty pitiful place with its own little currency. There's around 100 countries like Albania that have their own fake currency, and they don't really work. We have black markets, we take euro, we take dollars. And so giving those countries kind of a decentralized voice, one of my friends is an economist who said, well, those countries should just use dollars. And many of those countries do. The problem is you don't necessarily want to use some other country's currency, especially if that other country might become hostile to you. It's a really difficult place to be. So I think you want to try at least to have this nationless currency or sovereignless currency. I think would be pretty good for countries like Albania and probably the entire Balkans that don't want to be on euro and don't want to be on dollar. There's again probably 100 countries where Bitcoin adoption would be pretty welcomed and stabilizing force. So I do think you can see that in other countries before you see it in the U.S. And by then you have so much legitimacy that there's not a lot of resistance to the idea. And again, there's no actual way to sort of effectively ban Bitcoin. I mean, you can certainly try, but unless you sort of packet sniff everything on TCP/IP, and even then, I'm not really sure you can do very much. So, the key is that, of course, services and products get denominated in Bitcoin at some point, and I think that's really going to be a big turning point. So we're early, but I do think again, TPS has to be improved dramatically. I don't have a comment necessarily on Lightning. I don't want to say the wrong thing.
For the transactions per day on Bitcoin's roughly around 200K, and you were saying, comparing that to something comparable to like Visa, I think they do 100 to maybe 150 million a day. So definitely needs to be some improvement. But if I'm correct on Lightning, isn't it somewhere around supposedly? I mean, I need to do some comparable instead of the yearly. I think they said daily they could do to 1 trillion. I mean, I don't know. I mean, if that's just theoretical,
not bad,
practical, it sounds great on the white paper, but I want to see use case in real world scenarios on a large scale.
I think